Where are the registered inventories now for silver? Is it around 76 million?
Yeah, it's about 76 million, I believe. 43,295 Comex contracts held net short, which is the lowest short position that Ed Steer has recorded since he started doing this.
So
The
it's
big
just
eight,
just over 200 million.
Yep, and the same thing is true when you take the big 8 commercial traders, net short, 165,372 contracts. When you see in, I believe it was February, 25 million ounces were delivered, but 39 million ounces in silver left the Comex. 160% of what deliveries could explain alone left the Comex. Who is taking possession of 2 million pounds of silver? Who is running logistics for that? Where the hell is it going? How many trucks does it take to drive that out of the Comex vaults and bring it to where?
The discussion centers on a market that appears calm on the surface but is quietly tightening beneath the surface. Silver inventories appear increasingly strained, while large amounts continue leaving exchange vaults even during periods when price action seems weak. That disconnect is the heart of the bullish case. Andy Schectman and Mario Innecco believe the true sign is not daily price, but declining available metal, less commercial short exposure, and more physical delivery. They think informed buyers are adding during weakness, not chasing headlines. Silver's supply is fragile, stressed by industrial demand and geopolitics. Their main point: short-term price dips hide a stronger long-term setup for gold and silver. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The other thing that's happening, aside from all these deliveries, is that open interest is going down a lot in gold and silver. And I think that's a sign that Comex now has been used as it's becoming a physical exchange, which is really one for the books. And it shows that things are a lot more bullish than people think. So where are the registered inventories now for silver? Is it around 76 million?
Yeah, it's about 76 million, I believe. I might have it right here. I don't know if I have the actual numbers, but I can tell you, to your point, that the short position, the gross short position in silver is as low as it's ever been right now, maybe ever. And same thing with gold, not quite as low, but in both cases, well, here it is right here. The 43,295 Comex contracts held net short, which is the lowest short position that Ed Steer has recorded since he started doing this.
So
the big eight,
just over 200 million.
Yep, and the same thing is true when you take the big 8 commercial traders, net short, 165,372 contracts, down a further 3,406, their lowest short position that I have records for. So you're beginning to see, to your point, open interest fall, and maybe it's finally the brain dead money managers, the big hedge funds, who are finally sick and tired of being fleeced over and over and over and over again. So they decide, hell, I'm out of this game. Who's taking delivery? When you see in, I believe it was February, 25 million ounces were delivered, but 39 million ounces in silver left the Comex. So 160% of what deliveries could explain alone left the Comex. Who is taking possession of 2 million pounds of silver? Who is running logistics for that? Where the hell is it going? How many trucks does it take to drive that out of the Comex vaults and bring it to where? And then you see things like, China saying we're going to ban, exporting of what's the acid that they're
sulfuric acid.
Sulfuric acid, which is the main component for refining or smelting copper. Well, the majority of all of the mining, byproduct mining with silver, is primarily a byproduct element. Only 20-25% of what is mined by silver miners. The rest of it is those mining for copper, lead, and zinc. Well, if you make it very difficult to refine and smelt copper, and I think also lead, I think that's involved with sulfuric acid. I mean, you're going to put a major crimp on the supply chain for silver. But these big traders who are accumulating silver for industrial applications, are they going to wait to see that happen, or are they just going to jump in and stand for delivery now?
The Persian Gulf and the Gulf cooperation countries, and it could create a major crisis, not just there, but worldwide. So
I agree.
Yeah,
I agree.
so my question is, do you think we are on the cusp of things getting really bad? Because in terms of the war, it doesn't seem like Iran is going to bend to what the U.S. wants, and vice versa. And I don't see it stopping. So is that what you think could trigger a major explosion of the price of gold and silver, after this consolidation we've seen?
Yeah, and I think it could also really, really hurt the economy because, first, if you look at the jump in CPI, 75% of it is attributed just to gasoline. But first, the market says it's just oil. That's the way it always works. Then it becomes diesel, then it becomes shipping, then it becomes packaging, then it becomes groceries, then it becomes margins, then earnings, then layoffs. And that's how these things began to unravel. High debt plus higher energy plus higher defense spending plus slower growth is not a stable mix. And at the same time, it's like, I don't know, it's like globalization. It's like parallel systems that are being right in front of us, that are being separate energy routes, separate chip chains, separate mineral alliances, separate payment rails. And so ultimately this is very bad for the dollar. And so, I don't know. I think that, yes, this is ultimately what will drive the metals prices higher, because it will be the reaction of the Federal Reserve, that the chain reaction will begin with their overreaction to, they'll have to print money. That's the only way that they're going to be able to do it. We already have a $39 trillion debt, which is 124% of GDP as it is. Funny, by the way, as an aside note, that government spending is counted as growth inside.
Another key theme is pressure on the global financial system. Rising energy costs, larger debts, and increased defense spending create risks in an already fragile economy. Policymakers are likely to respond with more liquidity and intervention, ultimately weakening the currency. Both speakers stay positive on precious metals even during price drops. Weakness is seen as misdirection, not a bull market break, while strong buyers build positions. Gold and silver may benefit if rising yields show distrust in government debt. This phase could lead to a major move upwards. Let's get back to the interview.
You look at China importing silver. They're the second largest producer in the world. And we talked at length over the last year or so about how they've been going to places like Mexico and buying directly, disintermediating, and Peru, buying directly from the miners, disintermediating the market, buying it in doré and concentrate. Doré is a crudely refined bar, concentrate a byproduct sludge, paying double what the West will and shipping it back for refining in China. Well, they're the second largest producer in the world. Why would they do that? Why do they need to schlep all over there, pay double for stuff that isn't even refined yet, ship it back and refine it themselves? Because it's far more valuable than the dollar price would dictate. Well, you look at the January and February import numbers in silver, and right after silver got its teeth kicked in, China imported more silver in the month of February than at any time in recorded history. So as its teeth are being kicked in, China says, thank you very much, we'd like to buy some more. And so when you see the kind of deliveries that we're seeing and every single month on Comex, the most well-informed traders in the United States, and when you see the exact same thing happening by the central banks. So, to me, silver withdrawals have been, this is a note I wrote for myself. Silver withdrawals have been monstrous since the start of the year. 135 million in Q1 2026, 135 million ounces in Q1 2026, plus 4.236 million ounces so far in April. These amounts don't include the 8.26 million ounces issued and stopped on the Comex in the April delivery month so far. So again, you're continuing to see the biggest money on the planet accumulate metal on weakness.
If the end game is to revalue gold, and I think I don't know if you remember, J.D. Vance in February said that they want to put a floor underneath critical minerals
Yep.
because they want the U.S. to start exploiting, producing these minerals because China
Yep.
is monopolized it. So why do you think there's still a lot of manipulation?
It's only like two banks, too. I think it's mostly J.P. Morgan and Citibank, if I'm not, or maybe Bank of America and Citibank.
Yeah.
And J.P. They're the big ones, the three. Maybe it has to do with accumulation, that they throw these crumbs out there, but with all of the deliveries, why not? If you have the ability to knock the paper price down to quell the speculative frenzy that we saw, to allow, and again, who's standing for delivery for all this metal? Where's it going? A lot of it's leaving Comex. Not all of it, but a lot is. It's like China, who imports more in February as its teeth were getting kicked in than ever before. Well, you're seeing the same thing happening on Comex. Massive deliveries in February, which was a non-delivery month. And not only was it a non-delivery month, 160% of what was delivered left. And then again in March, and you're going to see the same thing here in April and May, the big delivery month. You will see this continue. Price is a tool of misdirection. Most people wouldn't even understand what we're talking about because they haven't followed it long enough. All they're seeing is the mainstream narrative that gold has lost its inverse relationship to the markets, and in fact is now trading in a form that is not a safe haven asset. That's what they want you to believe. They're going to have to ease, which will reignite the inflation genie to the nth degree. But I just want to dispel the biggest myth that drives me nuts, and that is saying, well, higher rates are going to kill gold. And if the dollar was stable and people wanted treasuries, I would agree with that. But no one wants our treasuries anymore, and the dollar isn't stable. So that higher interest rate argument for gold is exactly what is the cover, the misdirection, Sun Tzu, for gold and silver accumulation. And again, just go back to the period of time, during COVID, when the rates rose faster than ever. And in that period of time, right as we were coming out of it, when the rates were rising, gold was still going higher. So rising rates is not going to kill the price of gold. In fact, I think it signals why you need gold, because those rising rates are not organic.
As you said, in 2020, when the COVID crisis kicked off, they did a huge amount of QE. They bought treasuries. It went to 0.3. And at that time, gold went from 1,800 to 1,450 or something. And here we are, 6 years later, the 10-year yield is now 4.4 or wherever it is right now. So 4% higher, and gold is at almost 5,000. So
that's the point. It's a convenient argument when they want it to be, and conveniently ignored.
I agree. Like from 1981 to 2020, when you had higher yields, it was because the economy was slowing down, but people still, throughout that period, people had trust in treasuries. So but now we're in a bear market. Higher yields means people are dumping treasuries, and the anti-treasury is gold and silver.
That's exactly right, and that's why the rising rates is a foolish argument that is being adopted now by Main Street as being gospel. No. Rising rates are the death knell for gold. It's just a bunch of nonsense, especially taken in context with seeing how much gold accumulation is being done on the big exchanges and deliveries, coupled with the selling of treasuries by the sovereign banks. It's just so easy to see if you are able to take one step back and be impartial about it. I don't know. I think anyone silly enough to hold 10-year treasuries will get what they deserve, and that is a return, a guaranteed.
The bigger conclusion is that the market may be entering a phase where physical demand matters more than headline-driven paper pricing. Massive withdrawals, strong accumulation on dips, and ongoing delivery activity all suggest that deeper forces are at work beneath the surface. At the same time, the geopolitical backdrop remains unstable, and any renewed shock in energy, trade, or military tensions could accelerate inflationary pressures just as growth weakens further. That combination is why the outlook for both gold and silver remains so constructive. The expectation here is not based on short-term excitement, but on a structural shift: weakening trust in treasuries, a rising need for monetary easing, and a growing recognition that hard assets may serve as a form of protection in a less stable system. Gold is presented as the alternative to sovereign debt, while silver is shown as both a monetary metal and a strategically important industrial asset. If these pressures continue, the next leg higher could be driven by urgency rather than speculation. For long-term holders, this kind of setup is less about chasing price and more about understanding where capital may flow when confidence in paper assets starts to crack. Share your thoughts in the comments below. If you found this analysis useful, please like this video, subscribe to the channel, and turn on notifications for more updates.